Welcome to today's deep dive into the intriguing world of finance and investing. Our main focus, arbitrage. Now, you might be wondering, what exactly is arbitrage? Well, in the simplest terms, arbitrage is a strategy used by traders and investors to capitalize on price discrepancies. Picture it like this. It's like finding a $20 bill on the street and then realizing that you can buy the same bill from someone else for just $15. In essence, you're buying low and selling high, but the trick is you're doing this almost simultaneously in different markets or with different types of securities. This way, the clever arbitrageur pockets the difference as profit, all without any risk. Pretty neat, huh? It's a fundamental concept in finance and investing, and one with a lot of potential. Now that we've briefly touched on what arbitrage is, let's delve deeper into this fascinating topic. Arbitrage at its core is about exploiting discrepancies. It's a term that's thrown around a lot in financial circles, but what does it actually mean? Well, let's break it down. Imagine you're in a market, not a stock market or a foreign exchange market, but a simple farmer's market with stalls selling apples. You notice that one stall is selling apples for $2 each, but another stall, just a few feet away, is selling the same apples for $3 each. Now, what if you could buy apples from the cheaper stall and sell them at the more expensive one? That's essentially what arbitrage is. Buying low and selling high. But in the world of finance, things are a bit more complex. Financial markets are vast and spread across the globe, each with their own prices for the same assets. Traders use arbitrage to take advantage of these price differences. They buy an asset in one market where it's cheaper, and almost simultaneously sell it in another market where it's more expensive. This simultaneous purchase and sale is key. It's what allows traders to lock in a profit from the price difference, without actually taking on any risk from holding the asset. If done correctly, the purchase and sale happen so close together that the trader is, in essence, buying and selling the asset at the same time. Arbitrage relies on the fact that markets aren't always perfectly efficient. Sometimes, due to factors like geographical location, market regulation, or even simple human error, prices can differ for the same asset in different markets. And these discrepancies, however small, can be exploited for profit. But remember, arbitrage isn't about guessing which way prices will move in the future. It's not speculation. It's about finding existing price differences and capitalizing on them. With arbitrage, the goal is clear. Buy low, sell high, and profit from the difference. Arbitrage isn't a one-size-fits-all strategy. There are several types to consider. First, let's delve into risk arbitrage, also known as merger arbitrage. It's a strategy often employed by hedge funds where they bet on the successful or unsuccessful completion of a merger or acquisition. For instance, if Company A announces plans to buy Company B, the price of Company B's shares will likely rise. Traders then buy shares of Company B and sell them once the deal is finalized, pocketing the difference. However, if the deal falls through, the price of the shares crashes, and the trader incurs a loss. Thus, it's called risk arbitrage because it involves a certain level of risk. Next, we have retail arbitrage. This is a more accessible form of arbitrage that involves purchasing products from retail stores or online marketplaces at a lower price, then selling them on a different platform at a higher price. For example, you might find a brand name handbag on sale for $50 at a discount store, then sell it on an online marketplace for $100. The $50 difference, minus any costs, is your arbitrage profit. Finally, let's talk about statistical arbitrage. This type of arbitrage uses complex mathematical models to identify and exploit price discrepancies. It's typically practiced by sophisticated investors and hedge funds. These models analyze historical price trends to predict future movements. For instance, if the model identifies that stock A and stock B usually move together, but stock A is currently undervalued, the trader might buy stock A and sell stock B, expecting them to converge again. Each type of arbitrage involves different levels of risk, capital, and expertise. Risk arbitrage requires a keen understanding of corporate mergers and acquisitions. Retail arbitrage requires a knack for spotting deals and knowing what will sell, and statistical arbitrage requires advanced mathematical knowledge. Regardless of the type, the underlying principle of arbitrage remains the same: exploiting price differences to make a profit. The theory of arbitrage sounds straightforward, but how does it work in the real world of finance and investing? In practice, arbitrage is a fine art that requires a keen eye for detail and a firm grasp of market dynamics. Traders and investors are always on the lookout for arbitrage opportunities, which can spring up in various markets at any time due to discrepancies in pricing. This could be as simple as a stock being priced differently on two exchanges, or as complex as a multifaceted derivatives trade. Identifying these opportunities often involves sophisticated algorithms and high-speed trading systems. These technologies can scan multiple markets simultaneously, pinpointing price differences and executing trades within fractions of a second. This speed is crucial, as arbitrage opportunities often disappear as quickly as they emerge, due to market forces naturally correcting the price discrepancies. But let's illustrate this with an example. Consider the case of a company whose shares are trading for $10 on the New York Stock Exchange, but $11 on the London Stock Exchange. An arbitrageur could buy the shares for $10 in New York, then immediately sell them for $11 in London, making a $1 profit per share. This is a simple example of arbitrage in action. It's important to note, though, that real-world arbitrage is rarely this straightforward. Often, arbitrage strategies involve complex financial instruments and intricate strategies. For example, convertible arbitrage involves buying a company's convertible bonds while simultaneously short-selling its shares. If the company's share price falls, the short sale profits. If it rises, the convertible bonds can be converted into shares and sold at a higher price. Successful arbitrage also requires a deep understanding of market dynamics and the factors that drive price discrepancies. This could include everything from geopolitical events and economic indicators to company-specific news and market sentiment. As you can see, arbitrage involves keen observation, quick action, and a strong understanding of market dynamics. Now that we understand what arbitrage is and how it works, let's consider its role in finance and investing. Arbitrage is a cornerstone of modern finance, serving as a vital cog in the intricate machinery of our financial systems. Its significance can be broadly categorized into three key areas: market efficiency, price alignment, and providing opportunities for risk-free profit. Firstly, arbitrage contributes to market efficiency. It's a mechanism that ensures prices do not deviate substantially from their fair value for extended periods. How does it do this? Well, arbitrageurs, those who practice arbitrage, are always on the hunt for price discrepancies. When they spot these, they spring into action, buying low and selling high until the price difference is eliminated. This constant vigilance and activity help to keep the market prices in check. Secondly, arbitrage aids in aligning prices across different markets. For instance, consider a company listed on stock exchanges in New York and London. If shares in this company are trading for a higher price in New York than in London, arbitrageurs will buy the cheaper shares in London and sell them in New York. This activity will drive the price down in New York and up in London until the prices equalize. This process ensures that the same asset is not priced differently in separate markets. Lastly, arbitrage provides opportunities for risk-free profit. The idea of buying something for a low price and selling it for a higher price elsewhere is a fundamental principle of business. Arbitrage takes this concept and applies it to financial markets. It offers a chance for savvy investors to make a profit with minimal risk, as they're essentially exploiting price differences that already exist. So, as you can see, arbitrage is not just some obscure financial term. It's an essential part of the financial ecosystem, a balancing act that keeps markets in harmony. By exploiting price discrepancies, it maintains market efficiency, ensures price uniformity across different markets, and opens up avenues for risk-free profits. Arbitrage plays a crucial role in ensuring market fairness and efficiency. We've taken quite a journey through the world of arbitrage today. We've come to understand this intriguing concept, which is essentially the art of exploiting price differences in different markets for a risk-free profit. We've learned about the various types of arbitrage, such as spatial, statistical, and risk arbitrage, each with its unique characteristics and complexities. We've also seen how arbitrage is put into practice, with traders constantly on the lookout for these price discrepancies to make a quick profit. Perhaps most importantly, we've discussed the vital role that arbitrage plays in finance and investing. It's more than just a money-making strategy. It's a crucial mechanism that contributes to market efficiency, ensuring that prices across different markets don't stray too far from each other. And there you have it, a comprehensive look at arbitrage, the art of profiting from price differences. Until next time, stay curious, stay invested, stay